2. Okay. Hey everybody, welcome back to Just a Tip Tuesday. So this is a weekly video series where I sit down with an industry professional, we consume some liquid together, and we learn about all the things that school failed to teach us. So my name is Emmy, and today I am here with Jim Humphries.
Hello everyone!
At American Mortgage. And so legally, mortgage offices are not allowed to have alcohol. So we had to settle for vitamin water today. Go ahead and go to vitaminwater.com, enter promo code JUSTATIP, and there's a 5% chance that in the future you may get a discount. A little bit about Jim. Jim is actually 81 years old, and I am told that one of his relatives, he's actually distantly related to Benjamin Franklin's stable boy.
You've been drinking too much.
So today we're going to dive into the very exciting topic of mortgages.
Mortgages, yay!
So we had a ton of questions come in about mortgages. It's very clear that people have no idea what they're doing when it comes to mortgages, which is totally fine. So first of all, let's start out with the biggest question of the day. What is a mortgage?
A mortgage is when the bank lends you money to buy your house, and you pay them back over time. You pay the money back plus interest.
It's Seems easy enough.
Yep.
Okay.
Yep.
Huge question. Why would I buy versus rent? So what are some reasons that you have to buy versus renting, or what kind of fuels that
Well, that's
fire?
a good question. So first of all, there's a certain amount of pride in owning your own house, right? You get to do whatever you want. You get to, when you own it, you can have privacy. You can expand. You can fix things. You can, go build your basement to whatever you want it to be. You have all those things. And so you have this privacy, and you don't have to worry about neighbors right next door.
Right.
You don't have to worry about, you can do whatever you want, right? And then, of course, you get to use the taxes as a write-off, and the interest that you pay. All that's a tax write-off. So
nice.
at the end of the year, you'll pay the IRS less money.
Okay.
Okay, so that tax write-off really does make a big difference. And then over time, what happens is your balance is going down because you're paying into principal, and your value is going up in theory. And the value has been going up quite a bit in the last few years.
Okay.
So that difference, that gap, is your value, your equity. So over time, you're building more money. When you go to sell it down the road, then you'll get a lot more money back.
Okay.
Whereas when you rent, right?
Yeah.
You live there, you pay the rent, you move, you have nothing.
Right.
So that's really the difference in the money.
Got it. Okay, that makes sense. Okay, so if someone's rent, obviously rent is going to vary across the U.S., but if someone's rent is around $800, so what kind of home can they get for staying at the $800 a month mark?
So based on $800 a month house payment, you can buy in the greater Cincinnati area anywhere for between $100,000 and $120,000 home.
Okay.
It also depends on the kind of program that you're doing, whether it's FHA or conventional. And the taxes, the real estate taxes, are different in different areas. Okay, so that varies, and that's why you have the variance. And of course, interest rates tie into that. So at this time, you could buy $100,000 to $120,000.
Okay. And what does someone need to buy a home?
Well,
what do you need to have prepared?
Yeah, so they have to qualify. So they have to have established credit, and they have to have a 2-year job history in the same field. Doesn't have to be the same job. They can be on their current job for 2 months.
Okay.
But they've been in the same field for at least 2 years.
Okay.
That's very important. Now, they can be in school. You can you can be in college, and when you get your degree, if you go into the same industry that your major, then that counts as your history. Okay, so you have to be on the new job at least long enough to have 30 days of pay stubs. Okay, and of course you have the job history, and then you have to have some down payment. So you've got credit, job history, and down payment.
Okay. All right. Okay. Who would you need to meet with first? So obviously there are a lot of moving parts in the home buying process. And so between a real estate agent and a loan officer, who do you try and find first? Yeah,
the loan officer should be the first person you talk to. And if you go to a realtor, they'll ask you if you're qualified.
Okay.
Do you have a pre-approval letter? You can't get that without getting with a loan officer. So you should get with a loan officer first to see if you can qualify to buy any house.
Okay.
And if you don't, you put yourself on a plan.
Okay.
For some people, it's a 3-month plan. For other people, it could be 2 or 3 years. Just depends on what their credit history is like and how long it takes them to save up money. So they should get with the loan officer first to get pre-approved. And then if you don't, the realtor's going to ask you to.
Okay.
Because they don't want to drive around with somebody they're not sure if they can buy a house.
Right.
Okay.
Right. Absolutely. Yeah. Most real estate agents won't really talk to someone unless they're pre-approved,
Yeah.
right? Because they want to know that they're not wasting their time. And so obviously, we've known each other for a year now, and I can vouch that Jim is an awesome person. I don't know if you know this, but this is our 1-year Facebook friendiversary.
Oh,
I don't know
wow,
if you
cool.
saw. Facebook
Awesome.
made a video for us. Very exciting. So many people that I know can vouch for you, as I can as well. But for other people who don't have a good connection to a loan officer, how do you find a loan officer? Like, where do you even start to find one? Do you just Google it or what?
Well, you'd be surprised. You might have somebody like a friend or relative that knows somebody. Because
Okay.
remember, everybody that owns a house did a loan at one time or another.
Mm-hmm.
Okay, but a good resource is your realtor. Because
Okay.
the realtor will know a handful of good loan officers typically.
Right.
Or,
Okay.
like I said, a personal friend or somebody like that's even better because then they can tell you their personal experience
Right.
with them.
Right. So I feel like step one before looking online or even maybe asking the real estate agent, step one would probably be just calling a couple family and friends, shooting a text to them and just saying, hey, by any chance, do you happen to know a good loan officer? Like, you have no idea who people have in their network.
Right.
So that could be a good start.
Yeah. Or you can just call Jim Humphries.
Very true. Kentucky, Indiana, and Ohio.
In Ohio, yes.
And
Licensed
their
in-
office can also do North Carolina.
Yes. I'm with American Mortgage, and we're actually licensed as a company in 13 different states. But for me, I can do Ohio, Kentucky, Indiana, and my son Kyler, who's part of my team, can do North Carolina.
Huge question that I got asked when I did the Instagram poll. Big question was, how much money do I need to buy a house? How much money do I need to save?
Great question. So if you're lucky and you're a veteran, you can do zero down.
Okay.
Okay?
I am not.
If you're not a veteran and you buy a house out in the country, we can research a USDA loan. They have what they call eligible areas.
Okay.
And it's really more the rural areas, and that's a loan that you can do zero down. So if we don't do a USDA loan and we don't do a VA loan, then you have to have 3.5% for FHA.
Okay.
And if you want to go conventional, which is a little bit better of a loan, if you have good credit, it takes 5%. And then you have to have a little bit of money for your prepaids.
Okay.
We can have the seller pay closing costs and part of those prepaids. So I would say at a minimum 3.5% to do FHA, 5% for conventional, plus another $500 for prepaids, and the remaining fees can be paid for by the seller.
Cool. And if you have no idea what an FHA or conventional, like when you hear those words, if you have no idea what's happening, so in the second video that we're going to do, we're actually going to be talking about the difference between FHA and conventional and what you kind of want versus what you could qualify for. What credit score should you be aiming for if you want to get a good rate?
Okay. Well, if your credit score is 700 or better, you can get a great rate.
Okay.
So I'll start there. However, you can do a loan with a credit score, and by the way, it's your middle credit score. So they pull all three. When you go to buy a car, they pull one.
Okay.
When you open a credit card, they pull one of the
Okay.
repositories. Okay, Equifax, Experian, and TransUnion. When you buy a house, they pull all three. They ignore the highest, they ignore the lowest, and they use the middle.
Okay.
That becomes your official score. That official middle score can be actually as low as 580 to
Okay.
do a loan, but between 580 and 620, it's going to be a loan that's going to cost them a lot of money.
Okay.
It's well worth it to get your credit score at least to 620.
Okay.
Then we can do a standard FHA, but the higher your credit score, the better deal you're going to get.
Okay.
Okay.
Okay. So that is very important.
Yep.
And that is probably a whole separate video of how to have a credit score.
We'll get there, but I'd shoot for a minimum of 620 if I want
Right.
to get a good deal.
Okay. And then how do you know how much that you could qualify for your loan? Like, how immediately can they find out that information? How do they know that?
Okay. Well, we'll start with when you apply for a loan,
Okay.
the lender has to get all your data. They type it in the computer, push a button, it goes into the system. And FHA, they all have different systems. And when we run it through, if you have good credit, you could be as high as 50% of your gross monthly income. So
Okay.
if I make $2,000 a month, then I can have $1,000 a month of total debt.
Okay.
Okay, roughly 50% maximum. Okay. Out of that 1,000, that counts every debt that I have. If I have a car loan, it has to be in there.
Okay.
If I have student loan debts, credit cards, all that stuff. So let's just say that I have $400 in other debts.
Okay.
Student loans, credit cards, small car payment, then I can qualify for a $600 house payment.
Okay.
If my gross monthly is $2,000 a month,
Okay.
50% of that's 1,000. So you just do the math. If you make double that, then you qualify for double that.
Okay.
Okay? And it is on a case by case. We run it through the system and it just spits out an answer, yes or no.
Okay.
Okay?
Okay.
The algorithm brings in a lot of things and it's all put together. Okay? But the end result is either yes or no.
Okay.
Okay?
Another thing you mentioned was the 2-year job history. So how long do you have to be at their current job? Or how long does someone have to be at their current job before they can look at buying a home? Because that is something that shocked me, that played a factor into whether or not you could get a loan.
So let's say that a person, first of all, you have to have a 2-year history.
Okay.
Okay, and I mentioned earlier that can, if you're in school, that can be included if you're in the same industry.
Okay.
Okay, but if you don't have schooling involved, you have to have a 24-month history working somewhere in the same field.
Okay.
On your current job, you just need to be there long enough to have 30 days of pay stubs. Oftentimes, that's 2 months.
Okay.
Because you get there and you don't get paid for a while, right? And if you get paid every 2 weeks, your first 2 paychecks is 28 days. We need 30.
Okay.
So you got to be there a little bit longer. So to be safe, 60 days
Okay.
on that job, current job.
Okay.
And they only use your base income. So if you're getting lots of overtime, you're getting bonuses, stuff like that, they can't count any of that stuff unless you've been on that particular job for a minimum of 2 years.
Okay.
And then they'll average over the 2 years, and you can use that higher number, which makes gives you more buying power so you can buy a bigger house.
Okay.
Okay?
All
Makes
right.
sense?
I like that. And I think that was all we had for our
Yeah,
first
so
video.
next time we'll talk about the difference
Yeah,
between
so
FHA, VA, USDA.
the 0% down thing, which turns out is really pretty no bueno.
Yeah, you know the thing about 0% down, if it's not VA and it's not FHA, and you get one of the government programs, some of them are good, and they'll have grants that are out there. So if your timing's good and you get a grant, that's great. But if you don't, and we just do something like the Ohio Housing Finance Agency, people know those as bond loans. Those loans in today's world cost a lot more money.
Okay.
Okay, so if a person can get their credit score up, save the money, they can get a better deal.
Okay.
But we'll talk about the details next time around.
Yeah.
So I hope that helps.
Great. All right. Thank you for being here. And we will see you guys next week.
Cheers.
Woo!